welcome to another YCharts webinar. We're very excited that you're joining us today. We are very much looking forward to hearing from Brian and Brian. And let's get started. I am Connor from YCharts. I'm here just to introduce our two hosts, and then I'll be disappearing until the Q&A at the end of the call. But Brian Feroldi and Brian Stoffel, with more than 7,000 Motley Fool articles between them, they consider themselves financial educators first and foremost, but their expertise definitely does not stop there. They're interested in helping anyone and everyone with investing in personal finance, whatever that means. So today, they are going to be using YCharts and their years of knowledge and experience to talk about the PE ratio. A couple housekeeping items before I do pass the mic here. I do want to let you know that you can submit any questions via the Q&A function at the bottom of your Zoom window. Brian and Brian are going to do a Q&A at the end of the call, so we will set aside some questions and get them answered then. Second, there will be a recording of today's session made available. So if you're interested in that, you can check your inbox tomorrow. It'll probably hit you tomorrow and definitely by the end of this week. So we know folks like to see those recordings, and that is definitely coming your way. Finally, I do want to say that this is meant to be educational content, and YCharts is not acting as an advising party regarding client funds in any way. So now I've said my bit. Brian and Brian, I'll pass it off to you to get into the good stuff.
Awesome. Thanks, Connor, and thanks YCharts for having us. This is a topic that both Brian and I love talking about, valuation. It's one of the trickiest things about investing, and the PE ratio is something that tripped me up probably more than any other valuation metric. So I think that what we've learned about the PE ratio in our combined, 25, 30 years of investing experience, hopefully can help to save you some headache as it saved us.
All right. So let's get all the basics on the table to start with. The PE ratio. What does that even stand for? The P is for price. The E is for earnings. It's the price to earnings ratio. And you figure this out. It's very simple. All you do is you take a company's stock price, like Apple's trading for at the time of the screenshot, $146, and you divide it by the earnings per share over the previous year or over the trailing 12 months. You do that, you get your PE ratio.
Mm-hmm. So if you go to YCharts and you look at the key statistics, in this case, Apple is trading at $146 per share. Its diluted earnings per share over the trailing 12 months were $6.16. That gives us a PE ratio of 23.62.
All right. There is actually another way to figure out the price to earnings ratio. Not many people use it, but it's worth stating that if you take the market capitalization, which is the total value of a company on the stock market, and just divide that by its net income over the past year, you'll get the same number.
So there are a few different types of PE ratios that get quoted often. Three in particular we want to call out. The first is the most common type of PE ratio, and that's when it's just called the PE ratio. And what that uses is the trailing 12 months earnings of a company, so the TTM. And this is the one that gets quoted the most.
The next one is the NTM, or the next 12 months. That just means starting from the most recent quarter that was reported ahead over the 12 months, what they're expected to earn. That's what goes in the E in the PE ratio.
You can also hear about something called the forward 1 year ratio, which uses the next fiscal year's earnings in the denominator. But for the bulk of this talk, we're going to be talking about the most commonly quoted one in the news and one that comes up on all of the aggregator sites, which is the regular PE ratio, which calculates it's using the trailing 12 months.
So one of the questions that we just need to get out of the way is why does the PE ratio even matter? Well, if you're a beginning stock investor, if you have the same ideas like I did, you think that the price of a company's stock tells you whether or not it's cheap or expensive. As you get more experienced as an investor, you find out that on an absolute basis, the price of a stock means absolutely nothing. So how do you figure out if a stock or a company's stock is cheap or expensive? The PE ratio is the most popular price tag that investors use to try and figure out how to value a stock. Is it fairly valued? Is it cheap? Is it expensive?
Right. Price is a fact. The price to earnings ratio is context and is actually useful. So before we bash the PE ratio like we're about to, Brian, let's talk about some of the good things about the PE ratio and why it's so popular. First and foremost, It's easy. It's very easy to figure out what a company's price to earnings ratio is. Just take the current stock price, divide by the trailing 12 month earnings. Boom, you now know the PE ratio.
And guess what? Even if you don't know that equation, it's super fast to find because most websites like YCharts will do it for you. It takes a matter of seconds to find it once you pull up a company's page.
Moreover, you can use the PE ratio and you can compare it to the market in general, or you can compare it to a company's competitors. That gives you a relative idea of a value when compared to the overall market or the industry.
And then if you take a company's PE ratio and you take the inverse, you get an earnings yield. So for instance, if a company is trading for a PE of 10, the inverse of that would be a 10% earnings yield. Or if it's trading for 20 PE, that's a 5% earnings yield. And you can use that earnings yield and compare it to other investment vehicles, including things like bonds.
So I have to say up front that I absolutely love using the PE ratio when it works. It is my favorite valuation metric to look at. However, this is a talk about everything wrong with the PE ratio. And we're going to walk through 9 ways in which the PE ratio can be incredibly misleading to investors.
Now, here's the important thing to know about the PE ratio. We don't have any beef with the P. We're fine with that. It's the E that we have a problem with because as you're going to see, most people think that earnings just means profit, cash the company puts in the bank, but that's simply not the case. And we're going to go through the 9 different cases on why that's the case.
So before we get into that, I got to tell you a fast story. In 2006, I was working at a company that had just hired Salesforce.com to run our customer relationship management software. This was a brand new technology at the time. It took advantage of cloud computing. And I, as an employee at this company, immediately saw the value of Salesforce.com's technology. Now, I was an aspiring investor at the time, and I knew a little bit about money and finance, but not a lot. So I went to see if Salesforce.com was a publicly traded company. To my delight, it was. However, here's what I saw at the time. Salesforce.com's price was about $8 per share, split adjusted, and the earnings per share of the company were 5 cents. So that gave it a PE ratio of 160. Now, I wasn't a sophisticated investor at the time, but I did know that a PE ratio of 160 was way higher than the market in general and way higher than the historic norm of a company. So for that reason, I passed on investing in Salesforce.com, even though I thought the technology was really cool. You can probably guess what happens next. That decision to pass on Salesforce caused me to miss out on a 30+ bagger and counting, which has absolutely smashed the market's return. So this was my first instance with knowing what the PE ratio was and really seeing how it can mislead investors.
Fast forward to 2009. That's about when I got my start. And we've got Amazon being recommended by my own investing mentor, David Gardner. And when he recommended Amazon, there were so many things to like about it. I'm not going to read through that whole list. You'll just have to take my word for it. But I also went and I looked this up. And if you took the price, $163, divided by split adjusted earnings of $2, you got a PE ratio of 80. Again, the market, the S&P 500's average is about 15 or 16. So we're talking about something that is 5 times more expensive than the average stock, much like Salesforce. Now, luckily, that didn't stop me. I still bought shares. And much like Salesforce, that high PE did not mean that the stock could not get good returns moving forward. It absolutely did.
However, if you let that PE ratio dissuade you from investing, you had missed out on big returns. One more quick showcase of the PE ratio and how it can mislead investors. If you were looking at a company called Bed Bath & Beyond in 2017, you would have seen that the company's PE ratio in 2017 was 8.7. That is about half of the historic rate of the markets. And there's no way that you couldn't look at that and think, cheap. Very, very cheap if you know anything about the historic range of PE ratios. Well, if you bought Bed Bath & Beyond at that PE ratio of 9 in 2007, here's what happened next. You are now sitting on a 91% loss, 91% loss, even though you bought the company incredibly cheap according to the PE ratio. So that's what we want to cover next is the reasons why those three examples we just gave, the PE ratio led investors astray and the problems with using the PE ratio in analysis.
All right. Reason number one is because that E in the PE ratio earnings means net income, and net income uses something called accrual accounting. And accrual accounting means one thing, and it might not be what you think. It means that revenue and expenses, they're recorded when they occur, not when payment is received or made. So it's not cash accounting, it's accrual accounting.
And accrual accounting makes complete sense from a numbers perspective, but accrual accounting has some flaws and it can lead the numbers to be different from what you would assume that they would be. Let's take a real quick example to showcase the effects of accrual accounting. Let's say you go out and you buy a brand new car for cash. Okay, this car costs you $33,000. You believe that you're going to drive it for 10 years. And after 10 years, you're going to sell it for $3,000. Here is the accounting that you experience for owning this car. You have a $33,000 outlay in year one. You then drive the car for 10 years, at which case you sell it and you pull in $3,000 in net income in year one. So this is the cash experience that you have.
But accrual accounting wants to spread everything out over the period of time where the car is being used. So to do that, you take that $33,000 outlay, you subtract out what you're going to get back at the end, divide it by 10 years. And according to accrual accounting, you didn't lose $33,000 in 1 year. You're losing $3,000 every year over the course of 10 years.
Mm-hmm. So this would be the difference between cash accounting and accrual accounting. So a cash accounting, you would look like this on the left, but in accrual accounting, to smooth things out, to give a better idea of profitability, we would use the numbers on the right. So this metric would be used on the a company's depreciation expense. So rather than expensing $33,000 in year one, they would only expense $3,000 in year one, and then every year thereafter. Now, there's nothing wrong or nefarious about accrual accounting, but you do need to understand this dynamic if you're going to be using the PE ratio.
Right, because net income uses accrual accounting, and it's not just depreciation, which is what it was with that car. Accrual accounting leads to differences with cash accounting for things like accounts payable and receivable, amortization, depreciation, big ones, stock-based compensation, and deferred revenue. So there are a lot of ways that accrual accounting and cash accounting can diverge.
Now, let's give you a real world example of this phenomenon happening. So in 2019, Netflix reported a net income of $1.9 billion. Pretty good, almost $2 billion in profits. However, during the exact same year, the company reported negative free cash flow of $3.1 billion. That is a $5 billion delta between profits, what the company earned, and free cash flow, what actually happened to the company's bank account. What is going on here?
Right. So to understand that, you've got to understand Netflix's business model. If it gives the green light to a show like Squid Game, it did that back in 2019. And once it gives the green light to it, it gives money to the producers, the actors, the set directors. It has to pay for everything up front. And by paying for everything up front, Netflix's cash balance is going down in real life in their bank account.
Conversely, by 2021, when the product actually launched to the market and viewers started watching it, that's when Netflix could finally earn a return on the investments that it's made by having more subscribers and the subscribers that it has sticking around for longer by actually watching Squid Game during the time. So this is the difference between Netflix's income statement and the cash flow statement. The very dynamics of Netflix's business mean that it has to put huge cash outlays to pre-fund content, and it only gets to monetize them years later.
So if you look at the company's cash flow statement, which kind of corrects for this difference between accrual and cash accounting, you'll see that in 2019, at the top, they said they had $1.9 billion, but they spent almost $14 billion on new content.
So that was the main reason why there was such a massive delta between net income and free cash and cash flow in Netflix's case. Now, again, we say there's nothing nefarious going on about accrual accounting. We understand why that it happens. And Netflix is a more extreme case out there of the big differences between free cash flow and net income. But this shows one reason why using that E in the PE ratio can be a little bit misleading, because earnings and free cash flow aren't the same thing.
All right, let's move on to number 2. And this is one that's become really important lately. And that's that the E includes equity investments. What exactly does that mean?
So here is Shopify's net income over the last couple of years. We can see that from 2019 to 2021, roughly break even. Sure, they had a profit sometime and a slight loss other times. But then in 2021, profits skyrocketed. And then in 2022, we've seen a massive decline in net income. Now, you might think that the company was all of a sudden massively profitable, and then the company went to having enormous losses. But the details tell a different picture.
All right. So if we look at the company, this is the first quarter of 2022, Shopify's income statement. If we look at the bottom, we might see that they went from earning $10 per share, that was their earnings per share, to losing roughly $12 per share. That would be reason for panic if that meant that that's how the normal business was performing.
However, you have to understand that Shopify had actually made an equity investment in a company called Affirm. And one of the rules of accounting is when one company owns a stake in another public company, they have to mark up the gains on their investment when they make money on it, or when it goes in the green, and they have to mark down their investments when that same company loses value. And that's exactly what we saw happening with Shopify's numbers.
That's right. Now, and it's important to point out, they mark them up even if they don't sell the shares that they own. So when Affirm went public, Shopify was able to record a $1.3 billion benefit. And you might look and see that that is more than Shopify brought in sales altogether for the first quarter of 2021. However, if you follow Affirm, you know that the stock has gone down and gone down and gone down. So when Shopify had to report their first quarter of this year, they had a $1.6 billion loss. Has no effect on Shopify's underlying business, but because of accounting rules, that has to be included in the company's earnings.
So if you looked at the company's PE ratio in 2021, when it was marking up those gains, it would have dramatically understated. The number would be artificially low. More recently, because of this huge equity loss, the company's earnings have plunged deeply into the red, and it's all but disappeared. So the PE ratio really falls apart if one company owns a piece of another company, because that company's net income or earnings will swing up and down based on the value of their investments.
And it's not just Shopify. Big players like Amazon have made investments in like electrical van maker Rivian. And as that stock goes up and down, it has a meaningful effect on Amazon's earnings.
Or Google. Google owns investments in several other companies. Berkshire Hathaway owns investments in several other companies. A company I follow called Abiomed owns another med tech company. So for these businesses, the earnings is not going to reflect the core operating profits of the business. It's going to be hugely impacted by the share price movements of their investments. And that's going to make the PE ratio for these companies all but irrelevant.
All right. Third, there are one-time events when something happens once that have an outsized effect on earnings, and that can skew the PE ratio.
So let's go back and look at Starbucks, which is a company that I have personally owned for a long, long time. If we look at what happened in 2018, you see that prior to 2018, the company's PE ratio was in the mid-high 20s, maybe low 30s. And then all of a sudden, it dramatically fell into the high teens, and then it dramatically shot back up into the 20s or 40s. So what the heck happened here?
Right. So if we do a little research, what we find is that Starbucks reached a big agreement with Nestle, where it sold its consumer packaged good division to Nestle. They were the ones who had the right to market it. And when they did that, Nestle paid a huge one-time sum of $1.4 billion to Starbucks. So down there in the bottom, earnings per share, that went up significantly in 2018 and then fell So that explains the huge difference in the PE during that year.
So if you were looking at Starbucks PE ratio during this entire year, you were basing your assessment off of an artificially inflated number due to this one-time event. So one-time events, kind of like the equity investments we just talked about, can have significant impacts on the E, and that makes the PE ratio during these periods useless.
All right, number 4, there are times where we can be relatively certain that the earnings growth a company has is unsustainable.
So a quick example, back in 2014, 2013, when I was working for the Motley Fool, I was covering a company called Gilead Sciences fairly regularly. If you know anything about this company, you know that in 2013, they got approval for and launched 2 mega blockbuster drugs called Sovaldi and Harvoni. These drugs were cures for hepatitis C, which was a massively pent-up market opportunity for the company. And once they launched Harvoni and Sovaldi to market, their revenue and profits absolutely skyrocketed. Gilead's revenue went from 11 billion to 33 billion in the course of a year, and their profits went from about 3 billion to 18 billion during the course of a year. If you were looking at the company during this time, you saw triple-digit revenue growth and triple-digit profit growth.
So think about that. That means that the earnings were booming. And when that happens, the PE, because the E is in the denominator, went down from above 36 all the way down to 8.5, way below the average stock on the S&P 500.
So during this time, 2016, I actually was covering Gilead, and I see this is a company that's growing double and triple digits, highly profitable, trading at 8 times earnings. PE ratio is 8. I bought shares. I was like, this doesn't make any sense. And what I got wrong and what I didn't understand was that this was about to happen to the company's revenue and profits. Once Harvoni and Sovaldi came to market, so did a flood of other competitors, and that put downward pressure on the company's pricing. Moreover, because Harvoni and Sovaldi were cures for hepatitis C, they were having a harder and harder time finding new patients to give their treatments to. So that caused the company's revenue and profits to normalize back to levels that they should have been at. So in other words, during this time period, because of this almost one-time unsustainable growth event, the company's profitability looked like it was growing like gangbusters. In reality, it was an unsustainable fact.
And then think about that. So once it's unsustainable and the earnings start to collapse, you see that PE ratio go from about 8.5 that it was at to shooting above 60. All of a sudden, it does not look like a very good investment anymore. Again, that's because it was an unsustainable earnings growth spurt.
And this can be a really hard thing to spot in real time. If all you see is a company's revenue and profits growing substantially, it can be really hard to tell if this is a durable thing or if this is just a one-time unsustainable thing. But if it's an unsustainable thing, the PE ratio can often mislead you.
All right, number 5. There are companies that are being disrupted or their industry is changing rapidly, and the PE ratio will not account for that.
Unfortunately, one shining example of this is American icon General Electric, which has so many divisions and has been such a stalwart business for so long. However, more recently, a few of the company's divisions have come under huge competitor from either disruptive forces or from competitors, and that has caused the company's profits to be put under big time pressure.
So let's think about this. All the way from 1985 to 2008, this is what GE's net income, the E, looked like. Relatively stable and going up and to the right. And if you bought at that point, the PE at 14 looks awfully reasonable, about the market average for one of the best companies in the country.
Unfortunately, if you follow this company at all, you can probably tell what's going to happen next. We were at this point, we were at the artificial peak, net income for the company in 2008. And due to the great financial crisis and some trouble in some divisions, as well as a host of other problems, General Electric's profits have since collapsed and gone a deeply negative. So if you were buying the company, even though it sported a relatively reasonable PE of 14, this is what you've experienced over the last 20 years. An American Icon is currently down 74%, and it's just a shell of its former self. Yet another thing that's hard to spot if you're looking at the PE ratio, the company was about to have its profits get cut dramatically because of competition and because of disruption.
All right, number 6. When we talk about cyclical industries, the PE actually works backwards. But what does that mean?
Well, if you think about a cyclical industry, it goes through a boom and goes through a bust cycle. And because the price to earnings ratio uses those earnings in the bottom line, what happens during the boom periods is the earnings skyrocket. They go straight up. Well, if earnings are going up dramatically, that is pushing downward pressure on the PE ratio.
Okay, and then simple math here, during bust times, obviously earnings are going to go down, less business. If that denominator goes down, then that PE is artificially going to go up, making the company look very expensive.
So if you're going to be using the PE on cyclical companies, you actually have to look for the reverse of what you're expecting to. What do we mean by that? Well, let's take a look at ExxonMobil as an example. ExxonMobil sells oil, so its earnings are dramatically impacted by the prices, by energy prices. And we see the nature of this boom and bust cycle that the company's earnings have gone through over the last 20 years.
And here's the key thing. You want to be buying at the bottom of one of those when earnings are about to take off. But if we look at what the PE was at the peaks, we see a PE of 11 and 9. That made ExxonMobil look like a really good buy, a cheap stock right before earnings were about to collapse.
Conversely, at the bottoms or near the bottoms of those earnings, either the company's earnings go completely negative and hence the PE ratio goes into infinity, or they actually bottom out at a much higher number, such as 17 or 56. And that is because the earnings are artificially are depressed due to the boom and bust nature of the business. But actually, the most difficult and challenging time to buy these companies is when their PE ratios look cheapest, because that could indicate that the company is about to go through a mega bust cycle. And conversely, when the PE ratio looks the most expensive, that actually indicates that the company is about to go through a boom cycle. So with cyclical companies that have earnings that match the earnings cycle, the growth cycle of the economy in general, the PE ratio actually works best in reverse.
Number 7, there are certain industries where by dint of how the industry works, the PE ratio is not the metric that you want to use to give a price tag on a stock.
First would be the banking and financial industry at large. Banks have a lot of control over the earnings that they report based on how creditworthy they think their lending standards have been. They have complete control over how much they reserve against losses. And during boom times, they let go of reserves. And during credit cycles that goes the other way, they hold back on reserves. So this causes their earnings to actually fluctuate and be in complete control of management. So for bank stocks in particular, the PE ratio isn't that useful.
Think about your biotech stocks, okay? The life cycle of biotech is spend tons of money on trials up front, trying to get FDA approval. And at that point, there's no earnings whatsoever. And after you get that FDA approval and your drug is a mega hit, then all of a sudden you've got earnings, but they're probably inflated. So the PE ratio itself means very little when it comes to these types of companies.
How about insurance companies? Insurance companies often make money off of the float on their investments. That's one of their major sources of earnings, and that's dramatically impacted by interest rates of the day. Moreover, if there's a mega bad event like a hurricane or an earthquake or something like that, that can blow a hole in a company's profitability. So due to the nature of the insurance industry, the PE ratio also isn't necessarily a great indicator of value.
And then there are REITs. Now, REIT stands for Real Estate Investment Trusts. These are companies that their stocks have a special tax exempt status, and they rely heavily on those things that we talked about at the beginning with accrual accounting, like amortization and depreciation. As you saw, that can do wonky things to the company's earnings, which makes the PE ratio pretty meaningless.
Number 8, future growth potential and the S-curve. The next two we're going to cover, I would say, are the most confusing and the hardest for me to wrap my head around as an investor. But if you are familiar at all with the nature of disruption, you will know that disruptive technologies and disruptive companies grow according to the S-curve. So there's often during this S-curve a long infancy period when a technology is being perfected and lots of trial and error is going on. And before it reaches the necessary tipping point to mass adoption, there's a long drawn out phase when it's growing at a moderate rate.
All right. Now, here's the thing, though. Once you hit that tipping point, our brains are calibrated to understand linear growth. They are not calibrated to intuitively understand exponential growth. And yet that's exactly what happens during the S-curve when we have rapid expansion and mass adoption of a new technology. Of course, there are limits to that, and eventually it enters a stage of maturity that it regulates again.
And if you need examples of this from history showing technologies, disruptive technologies being adopted using S-curves, here's a couple from the last 100 years. The telephone, radio, air travel, TVs, cell phones, internets, social media, tablets, all disruptive technologies that were adopted looking at the S-curve. And if you look more recently, the S-curve rates are actually getting sharper and more pronounced than they have been historically. So understanding the fundamentals of the S-curve is really critical if you're going to be investing in these dynamic businesses.
So let's go back and let's just use that same example that we talked about before of Salesforce, which was at that point where the arrow was when Brian came to it. It was 2006. It was hard to tell that it was going to experience the type of ridiculous exponential growth that it has over the next 2 decades.
This is what's happened to Salesforce's revenue growth over the last 20 years. It's a smooth curve that gets faster and faster as long as you go along. And it just shows how adopted its technologies have been. But if you also track the earnings per share of this company, you can see that for basically a 15 or 20 year period, earnings were doing nothing. Diluted earnings were doing absolutely nothing. And only more recently did they skyrocket. So because this number is in the denominator of Salesforce.com, that's why when I was looking at the PE ratio back in 2006, I saw some huge number because the earnings power of the business was not shining through yet. More recently, the company has been focused on profits, although still not to the degree that to maximize them. But the PE ratio has actually gone down sharply during this period, even though the stock is up tremendously over this period, simply because of the S-curve adoption of Salesforce technology.
All right, so that's the S-curve. Really important to remember because remember, the PE looks backwards. So if you're at that tipping point, looking backwards at the infancy, that you're going to be completely blind to the rapid exponential expansion that's about to come.
Okay, number 9, and then we're going to move on to some ways we think about valuation and get to some Q&A. Thank you for sticking with us so far. We're going to talk about one of the hardest things to wrap your head around, which is operating leverage pent up in a business. And to understand operating leverage, you first have to understand that businesses have 2 types of costs, broadly speaking. There are fixed costs and there are variable costs.
All right, so fixed costs. The idea behind fixed costs is that these are things that you as a company are going to have to pay for, whether you sell, let's say in the case of Tesla, 1 car, 10 cars, 100, 1,000, no matter what. Things like your overhead, your management team, insurance, research and development. You're going to pay that no matter how many cars you sell in a given year. Those are fixed costs.
Then there's also variable costs. So every time Tesla makes and sells a car or a Powerwall, whatever product that it's making, it has to pay more for steel and tires and chips and electricity and employees, and all kinds of costs go up and down depending on total volume that is sold. And understanding the dynamics between fixed costs and variable costs can be a little bit complex, but it's something you really have to make a mental model for yourself if you want to understand the way that your earnings work. So to really hammer home how this works, my friend 10K Diver over on Twitter created a great animation that shows this process in action. So as revenue grows, fixed costs stay the same and variable costs scale with it. This means that total costs actually grow slower than overall revenue. When this happens, the amount of profits that a company can keep after it reaches the break-even point can grow at a faster and faster rate than revenue can. This is what's called operating leverage and operating. So this is a key concept to get into your head. Is that as a company continues to grow and add scale, it can often try and drive margin improvements, which leads to outsized growth in profitability.
All right. So we picked Tesla for a good reason, because this is a great example of operating leverage. In 2020, Tesla had about $31.5 billion in sales. However, it only converted 2.3% of those sales into net income. So it was only keeping about 2.5 cents for every dollar in sales that it had. That's 2020, when they were optimized for sales growth.
Right. The whole business during the last 20 or so years has been optimized for sales growth. And because of that, it's the earnings power of the business is understated. But if you look what happened in 2021, the company became far more optimized for profits than at any time during its history. And you see that the company started in 2021, kept 10 cents of every dollar in sales as profits for itself. So it went from keeping 2 cents for every dollar in 2020 to 10 cents for every dollar in 2021. When you combine that with the huge growth in sales over that time, there was tremendous growth in the company's earnings on the bottom line due to operating leverage. So broadly speaking, if you look at the picture, Tesla in 2020 was about here, and then in 2021, it shot forward to there. Now, what does that mean for investors that use the PE ratio on Tesla? In 2020, it had earnings per share. It had earnings, but it hadn't yet reached maturity. It wasn't yet optimized for profit. So if you look at Tesla anytime during this period here, the profits and the profitability of the company were understated compared to where they are today. It wasn't until this period here that the company has been fully optimized for profits. So I would argue that it's really only in the last 6 months to 9 months that the PE ratio is actually a meaningful metric for investors to look at when judging the value of Tesla.
So Tesla's not the only example. We've talked about Amazon. So on the top, you've got Amazon's sales from when the company went public before 2000 all the way to 2020. And you see that exponential curve going up to almost $500 billion in sales. However, despite those sales growing so much, when you look at the bottom, which is the net income for Amazon, you see that it was optimized for sales growth for the first 20 years as a company. And it wasn't until the last 4 or 5 years that the company has finally been more optimized for profit. It could still improve there even more. It has more leverage ahead. But that's why if you were investing in the company, if you didn't understand that operating leverage was about to kick in, you would have thought the stock was incredibly expensive.
Especially when looking at the PE ratio, and investors were screaming about this for years. When is this company going to make a profit? When is this company going to make a profit? It was only in 2016 that the company actually tried to start making a profit. And you can see the actual earnings power of the business started to balloon once it did so. Now, even today, the company is overbuilt out and it still is not right sized. So the earnings power of the business is still hidden from investors' view today. But this is why the PE ratio hasn't worked on Amazon for a very long time.
All right. So those are your 9 reasons why the PE ratio is not a silver bullet. It is not always the best way to figure out a price tag. Now, all the cards on the table. When it comes to valuation, some of you might know that I usually don't pay attention to valuation at all. However, that makes me a bit of a heretic. Brian Feroldi has come up with a much more nuanced approach to this that I think it's worth going over.
So we're going to just look at a couple of different valuation metrics that investors can use based on what the company is trying to optimize for on the income statement. The simplest one to look at is you take the market cap divided by the company's sales, and you get the price to sales ratio. This is oftentimes the only thing that you can look at for some companies that aren't focused on anything else except for revenue growth. However, if a company is optimized for gross profit, but not net net income, I like to look at the price to gross profit ratio. If a company's optimized for EBIT or earnings before taxes, it can be useful to look at the price to EBITDA ratio. You can only use the price to earnings ratio when a company is fully optimized for net income, and there's also none of those other factors that could make the earnings power of a company be obscured for one reason or another. We also had to throw in there the valuation metric that Brian does actually look at when he's looking at it, which is the price to free cash flow ratio, which is the market cap divided by the free cash flow of the company. So that is using cash accounting versus the accrual accounting of a business.
All right. So one way that we can know when to do this is we break down companies into different places in its life cycle that it's in. So you've got your companies that are in the R&D stage. They don't even have a product out there. There is no metric that you can use other than what we call the price to hope ratio, because there's nothing to base it on.
Conversely, if a company launches the product, it's oftentimes during this phase that everything is focused on the top line, grow the top line, grab customers, grab market share. And it's not uncommon for these companies to be producing losses on the bottom line. So during the launch phase of a business, the only metric that investors can be used to judge value is the price to sales ratio. And it actually doesn't become meaningful until after the company has had some traction with sales.
All right. Then we finally hit that tipping point. You've got the hyper growth. Revenue is taking off and the company crosses break even into profits. It's not optimized for profits, but it's making some. Therefore, Brian especially tends to prefer price to gross profit, not one you hear about very much, but an interesting one to check out.
Finally, the company, if all goes well, reaches the maturity stage. Sales growth becomes steady state. The business is fully optimized for profits. And during this stage and only this stage, the price to earnings ratio becomes a meaningful number that we can look at.
All right. And then once your companies start to go into decline, we talked about GE, there really isn't any type of metric that's going to let you know whether or not a company is a stock is a good buy or not. If the underlying company is going down, the stock will eventually fall with it.
So what happens is that investors, especially new investors like I was a long time ago, like to look at the PE ratio. We look at the PE ratio and say, yes, it makes so much sense. And we get into trouble when we use the PE ratio when a company is in a different phase of its growth cycle. During any of these phases, except for maturity, the price to earnings ratio is often a meaningless number, and it's something that you can't rely on. And even during the maturity phase, there's a whole bunch of companies and a whole bunch of instances when the PE ratio simply doesn't work for the dynamics we've laid out in this presentation. So I absolutely love it when the PE ratio works. It's my favorite metric to look at to judge a value. The unfortunate truth is the PE ratio only works in a handful of instances in a handful of companies.
All right. So again, there's a lot of things that matter more than just the PE ratio that we like to go on. It's still a data point that's worth using for most investors, but it's not the only data point.
So let's go through a couple of quick examples of companies that are public today and where they are on the growth curve here. So if you want to look at companies in the R&D phase, this would be your clinical stage biotechs, companies like Fisker, basically any company that is about to launch a product or has hoped to launch a product but isn't generating any revenue yet. The only thing you can look at here is essentially the price to hope ratio, or look at the total addressable market opportunity and put some kind of number on the chances of succeeding there. So there's no metric that you can use to say, hey, this stock has a good value.
All right. What about companies that have at least launched something like Rivian or Lucid, electric vehicle makers, or App Harvest? They probably don't have profits. So the best that you can do is to look at the company's price to sales ratio.
Moreover, if you look at companies that are growing rapidly and haven't yet achieved profitability yet, such as SentinelOne or say UiPath or Fiverr, these are companies that are not yet focused on bottom line profitability, but they are focused on revenue and gross profit growth. So for these companies, my preferred valuation metric is the price to gross profit ratio or the price to EBIT ratio in some circumstances.
It's only when your big companies like Apple, Microsoft, Google, Johnson & Johnson hit the maturity stage, and you think about some of those one-time things we talked about, that the PE ratio actually becomes somewhat useful.
And then finally, in that decline stage, like GE, like Pitney Bowes, like Sears, like JCPenney, companies that are likely to be in a permanent state of decline, the PE ratio can just be very, very misleading because it's often looking backwards at the previous earnings power of a company. But if that company's earnings are headed towards zero, so is that stock eventually.
All right, so let's just review. Accrual accounting makes the E mean something different than most people think it does.
Reason number two, the PE ratio doesn't work is because of equity investments. If one company owns an equity piece in another company, that can obscure the actual earnings power of the company.
Number three, there are one-time events like when Starbucks sold off a division that can inflate earnings.
Number four, if the company's earnings growth is riding an unsustainable trend that is about to reverse, the PE ratio won't work.
Number five, there's industry disruption and businesses that go out of style. And when that happens, it won't be accounted for in the PE ratio.
Number six, if the company is in a cyclical industry that's prone to boom and busts, the PE ratio actually works best in reverse.
Number seven, there's certain industries like banks, biotechs, REITs, that it just doesn't make sense to use the PE ratio.
Number eight, if an industry is about to go through rapid growth or if a company is about to hit an S curve, the PE ratio by looking backwards will often dramatically understate the company's actual potential.
And number nine, operating leverage. It can perform magic and make earnings grow very fast, meaning that the PE ratio looking backwards won't be able to see that coming.
So there you have it. So the PE ratio really only works in the maturity phase when there's no one-time random things going on. So if you're going to use the PE ratio for get a sense of value, make sure you're using it in the right circumstances, because if you're not using it in the right circumstances, the PE ratio can actually be more of a mirage than a helpful tool.
All right. So that is our presentation. Again, we love using YCharts. We use it all the time to create visuals, share insights. You can start a free trial at YCharts.com. You mentioned Brian's name, you get 20% off. And we want to make sure that we have time now for some questions.
Thank you. Hope you learned something, and we're happy to answer any questions that you have.
Awesome. Thank you, Brian and Brian. For everyone who wants to stick around, we will be going up to the end of the hour with as many questions as we can get to. So without further ado, whoever wants to take this, I just picked out a few from the Q&A. So we talked a lot about those different maturity stages. And a good question was, where are you getting signals to identify where a business belongs? We heard some great examples, but is that an eye test or is there something to follow there?
Yeah, I would look at the company's financial statements. I mean, the company's financial statements, unfortunately, are backwards looking instruments and they show you what happened, but they can often give you a clue, especially when looked at over sequential quarters or even better, sequential years, to give you a sense of that. Basically, I start at the top and work my way down, and I focus far more on margins and percentage changes than I do on the absolute numbers themselves. So if I see something going on, I start with sales and then I look. My eyes go immediately to gross profit. And if gross profit is growing, that's a good sign. And then I go down to everything else. But the financials will tell you where the company is. Brian?
I was going to say, look at the sales growth rates. The sales growth rates will tell you where it is. It'll tell you if you're hitting the steep point of the S curve. It'll tell you if you're hitting the maturity phase of the S curve. And when that happens, then you can start to think about using different metrics.
Excellent. Yeah. So a good metric-based approach there, but then also, you mentioned the product launch as well. That could be a very clear indicator of where they are and those revenue numbers to follow as well.
This is one reason why investing is hard, by the way.
The only one sometimes.
Yeah, the only one. No, that's right.
Yeah. Another great question came through in terms of finding companies that have these outside equity investments. Any resources or tools you can mention for finding them and how many?
The biggest thing that I would just say is if you go into the annual or the quarterly reports and you read through where it says other income or expenses, that's the big section, other income or expenses. If there's one large one or a few large ones that are driving it, they will mention it in that section.
Mm-hmm. Yeah, oftentimes, especially if it's bad, management will call it out right in the press release up front and make sure you're aware that don't look at our GAAP numbers, look at our non-GAAP numbers, which adjust for those things. That's one reason why a lot of investors, myself included, really like non-GAAP numbers, because they adjust for those one-timey things. But if you know accounting, you know that non-GAAP is no perfect panacea either. And there's all kinds of reasons why non-GAAP numbers can be deceiving too.
Yeah, probably something that those the analysts will ask about on the call as well. Talking about some specific metrics and alternatives to the PE ratio, I think Brian Stoffel was mentioned. You're a fan of the price to free cash flow. If you could just elaborate why you like that metric in certain situations.
Sure. And I won't get into the whole way that my framework works, but the idea is I think that one or two events that we cannot predict are going to drive 90% of what happens in the future. What I want to know is I've got a company that is able to survive and thrive when that unpredictable thing happens. COVID would be one type of example. And free cash flow is measuring the actual amount of cash that comes in that's on hand over the previous year. That tells me whether or not a company can use that cash to take advantage of a situation. So I'm less of a steady state type investor and more of a, how ready is this company to handle something really big and really bad?
Got it. One more question on some of those specific metrics. Would the price to book, would you recommend using that valuation metric for anything other than banks?
That's the one that it most applies to. I think for insurance companies too, price to book is a balance sheet metric, and it's better. It's good. It's much better value, sense of value for banks in particular, insurance companies in particular. It's not something that I personally ever use because I'm not a bank or financial investor myself, but those would be the ones that I can think of.
Okay, great. One interesting question here, with all of those different stages of the maturity curve, price to sales, price to gross profit, are you always comparing those to industry averages or industry ranges? Is that always the case?
I'm trying to keep in mind where it is on a relative valuation perspective. So valuation, like we said at the start, is one of the trickiest things that you can do as an investor. And what is reasonable for one investor is unreasonable for another. And it doesn't. And the market is going to puke up your results if you're in a bear market like we are right now, or bid it up to crazy highs like happened in 2020. So I use those numbers more to get a sense of where the company, how highly investors are valuing that company at any given time, whether they're extremely excited about it or extremely pessimistic about it. But the actual amount, the true amount that you should pay is going to depend on a bazillion different factors, to say nothing of the company's like growth rate at the time, or how wide the moat is, or how good the management team is, or what products could be on the horizon. So unfortunately, there's no like hard or fast rules. This is one reason that the PE ratio is so great, by the way. You can look at the PE ratio when it works and just say, what's it compared to the market? What's it compared to the S&P 500? That's a really quick way to say, is this company more valued than the market, undervalued when compared to the market? And you can do some digging in more. So each of those metrics, price to sales, price to gross profit, price to EBIT, price to free cash flow, it's always situationally dependent.
Yeah. And I think a key point there that I'm taking away is looking at that individual company as well and where it is on its own journey, like comparing that metric to itself over time.
Very much.
Great. We talked a little bit about kind of the market averages for price to equity ratio. It's the one most of us are probably familiar with or have heard quoted, but would either of you give a guide on what's a high or a low price to gross profit or a price to free cash flow?
I'll just take the second one. Price to free cash flow it mirrors price to earnings. Over the long run, PE and price to free cash flow should converge over a long enough time period. So I'd say that like a 15 is probably about what a market average would be.
Yeah, I like looking at price to gross profit a heck of a lot more than price to sales in particular, because the price to sales can be very misleading if that's the only tool that you know. But there's a massive difference between a company with 80% gross margins and 20% gross margins, and all things held equally, the company with 80% gross margins should trade at 4 times the price to sales ratio of the one with a 20% gross margin. So going down to gross profit profit is such an underrated term, in my opinion, because management has full control over everything that happens below gross profit. They control all levels of spending. They control their interest expense. They control everything, right? So management can manipulate their costs beyond that. It's much harder for them to get sales out there, and particularly to dramatically improve their margins over time. So I think price to gross margin helps to eliminate the fact that companies can have hugely different gross margin rates. But if you're going to think about it, I kind of think about it like the price to sales ratio, just like a little bit higher. So a price to sales ratio of 10 in absolute terms is very, very, very high. So a price to gross profit of 10 is also very, very high. If you can find a company that's trading at like 2 to 4 times gross profit, that's really bargain bin. If it's 6 to 10, that's on the higher side, and over 10 would be more expensive. But those are just rough guidelines.
Yeah, good to just have that little mental barrier or mental guidelines. One that a question came in from Scott that we did not discuss thus far is the PEG ratio. Wanted to get if you guys have any thoughts, warnings, positive thoughts on it.
So when I started investing, PEG ratio was everything that I used. And for those that don't know it, you take the PE ratio and you divide it by whatever the growth ratio is supposed to be moving forward. So a 1 is fairly valued, less than 1 is cheap, over 1 is expensive. The thing is show me someone that can reliably predict the future, and like I will wonder why that person is not a bazillionaire, because nobody can do it. So it is a data point, but it is one that I thought was the silver bullet, and I found out the hard way that just wasn't the case.
Yeah, with all of these. So first off, everything we just said is wrong with the PE ratio applies to the PEG ratio, yes. Right? So if you can find a company that truly the PE ratio works and you can predict its growth rate reliably, then the PEG ratio could have some value. But when it comes to valuation, I think the smartest thing that investors can do is get a range of numbers, a range of metrics to judge a company versus the market versus its peers, and just ask themselves if that makes sense. That's a much better guide than relying on any one figure, including PEG, including PE, including price to gross profit, including anything.
Awesome. Thank you both. I'm going to ask one of my own questions before we sign off here today, but just looking at YCharts, looking at the S&P 500 PE ratio, I know we talked about ignoring the PE, but spiked up to 40 in the midst of 2021. And now the market PE, we're seeing back down to 22.8 and expected to continue falling through 22 and 23 based on the forward PE. So any comments, any thoughts here about what this implies for the market overall in stocks?
I don't have any comments about what that implies. What I would encourage you to do is go back and look at how many of those previous estimates that have been made are even in the ballpark of correct. Now, I'm not sure, but I bet what you'll find is that a very small percentage of them are. So that's why we are terrible human beings. We are terrible at accepting the fact that the future is unknowable. And we will tell ourselves any story that we can to make it easier to sleep at night. Unfortunately, while that does help us sleep better at night, it is terrible at actually preparing us for the future. So keep that in mind when thinking about, whenever I hear an expectation moving forward, a little red flag that goes up saying, this is someone talking about something that they think they know, but nobody knows.
I'll throw in there, keep in mind what happened to the earnings of the S&P 500 over the last 2 years, right? Some sectors in 2020 were decimated. Just decimated, right? They almost shouldn't have existed anymore. Airlines, what were airline profits? What were hospitality profits, right? So many companies' earnings went to zero, negative, hugely negative. And other companies' profits skyrocketed, right? In 2021, was everything normalized? Was everything back to normal? I'd argue the answer there is no. Are earnings back to normal today? I would still argue probably not. So it's not that number isn't useful. You just have to keep in mind, are the earnings power of the companies in the S&P 500 accurate as of right now. That is when the PE ratio is most useful. Now, the PE ratio on the S&P 500 is so much more useful than looking at an individual company, because if you spread it out over 500 companies, all those factors we just talked about tend to be far more normalized. So it's much more useful. But look what happened to the price to earnings ratio in 2008 or 2009, the losses in the financial sector were so large that the earnings of the entire S&P 500 went negative. So the PE ratio at the market bottom looked like it was like a few hundred or a few thousand, simply because the earnings power of the financial industry overwhelmed every other sector of the economy. And that proved to be a tremendous buying opportunity. So the PE ratio on the market, just like with an individual company, ask yourself, is the earnings power of the market today normalized? If it is, it's useful. If it's not as useful.
Awesome. Okay, two points there. Is the figure normalized? Does it make sense right now? And then also, where is this estimate coming from, right? Like, who is the person behind these numbers that you're might be relying on?
And did that person predict COVID in 2020?
There you go. Or a war in Eastern Europe in 2021, 2022.
Right.
Yeah. I like everybody suck at accepting the fact that the future is unknowable, but that's a really hard thing to understand.
Got to get used to it.
What's the interest rate going to be next month? What's the inflation rate going to be next month? 3 months from now, 6 months from now? Is the war going to get better or worse? I don't know. I don't know. And I don't trust anybody that says they know.
Yeah. All right. Brian and Brian, thank you so much for your time. This was an awesome conversation. We hope everyone on the call learned a thing or two. Again, I saw some people asking about the recording that is coming your way tomorrow. I'll turn it over to you, gentlemen, to say goodbye for the day.
Thank you guys so much for watching. We hope that you learned something. And by the way, if we got something wrong, which is entirely possible, please reach out to us and let us know. We are always on the hunt to upgrade our own thinking. So if you think we made a mistake, please let us know.
Yep. Hit us up on Twitter. We love learning. Our motto is to get a little bit less dumb every day. Hopefully we helped you do that as well. And YCharts, we just want to thank you guys for having us on.
Absolutely. Pleasure is ours. Thanks, everyone.